moving on to our next session. So our changes on the capital gain is continuing with the focus now on non-financial assets. So we are pleased to welcome Raghav Kumar Bajaj, Counsel at Khaitan Co. Raghav specializes in income tax, corporate taxation, cross-border tax, digital taxation, and transfer pricing. With extensive experience across various sectors, he also provides advice on business restructuring and tax dispute resolution. A chartered accountant with strong academic record, Raghav has been featured in VW Legal World 40 Under 40 and the World Transferring Prize rankings. He's a regular speaker at professional events and actively involved in Rotary International. Hi, Raghav. How are you?
Good, Rhythm. How are you? Thank you for inviting me.
Very well. Thank you for being part of this marathon.
No problem. I think it's always good to be part of Taxmann's initiatives. Anything whenever budget comes, I think first forum to do all these things, Taxmann. So great to be back.
Thank you so much. So now the stage is yours to take up.
Sure. I'll just share my screen.
Yes.
Let me know if you're able to view it.
Yeah, it is visible, but you can put it in the screen sharing mode, please. Or is it the PDF? I think it would work. Just maximize the screen.
Let me put it in the PPT mode then. Is it better?
Yeah, good to go.
Okay, great. Thank you once again. So as we've already, heard about the capital gains changes with respect to the financial assets, the next most important topic, I think, of the budget is how do the non-financial assets fare? It would be, I think, fair to say that at least the capital gains portion has been the much talked about amendment proposals of this budget. And why not? Because at one place, I mean, before budget also, there were so many discussions, debates, deliberations as to what will happen with the long-term capital gains tax regime, be it financial assets, be it non-financial assets. And to be honest, this distinction between financial and non-financial assets is something which people were not very used to, at least before the budget. Then the important point everyone is talking about, that indexation benefit and what is going to be the impact, at least what Brendan has dealt with is with respect to the listed equity shares, the financial assets. But now I think it's time for us to understand how does it impact A, the other classes of assets, and B, what is going to be the impact in future. Because see, honestly, 23rd July is a day which has gone by. So now this is the proposal which is there. It is now up to the government to enact it. With or without amendments. Now let us see what is there in it for us in current form and shape, and how is it going to affect the different stakeholders and different pockets. So today we are going to, I've divided this session into, let's say, 5 parts. Where of course we are going to deal with the tax rates, the holding period, etc., related amendment proposals. One interesting food for thought as to with respect to the date of transfer, because that is something which will be important, as this is an amendment which has been proposed in the middle of the fiscal year. It is not something which is effective from, let's say, 1st April or 1st January or anything. It is in between the year this is going to be effective. Then I've brought about some case studies so that we are able to understand the implications better. How is it going to impact? Some other considerations. And I think in the end, I would like to sign off with some suggestions as to how this particular amendment proposal can be implemented, maybe in a different fashion. But before we do so, I think for 3 slides, I would want to touch upon some key policy updates and economic survey highlights that were there of this budget. And I'll tell you the reason. It might take, let's say, 3-4 minutes, but I'll tell you the reason why it is important for us to know these developments and where the economy and the policy level changes might be going forward. So if you see with respect to real estate and infrastructure, again, the government was upbeat about fostering the private sector involvement in this field. There were enough opportunities and enough policy announcements that they will want to do viability gap funding. The industrial parks announcement was a very good thing. Establishment of plug and play industrial parks, again something which is the need of the hour for a country like ours. Then the proposals with respect to ship ownership, leasing, and registration. I think this is something again where we are We are wanting to be the leaders, and we are doing year on year something else. Like few years back, we had this aviation leasing thing. Now we are moving to these things. Ultimately, the reason is that the government wants to give stimulus to different industries and create job opportunities. With respect to housing sector, the announcement for housing sector was very good, and this creation of rental housing with dormitory style accommodations, again, this was also a great point. But if you see the last 2 points, and that is something which I want to touch upon in detail. See, there was a proposal of, and this has been going on the round since I think past few years, that digitization of land records is required very much. But I think the second last one is something which we must be mindful and we must take note of. Uh, the state governments have been encouraged to lower the stamp duty rates, particularly for properties owned by women. Now, as you know, this was the union budget. This was something which was done by the central government. But the important point is that they have encouraged the state governments to do it. Now, whether they will do it, will they do it, when will they do it? All these are questions for times to come. But I think this is an important point for us to note, that in future it is possible that we might see stamp duty rates getting lowered. And I'll tell you why I'm making this point that we might see. Because if you see the economic survey, see, on 23rd July, for everyone thought that, okay, it is like a surprise that, capital gains regime has gone and has got an overhaul. But if someone read the economic survey, one which comes one day before, in that there was a mention that a staff discussion note of the IMF, amongst other things, has recommended enhancing the taxation of capital gains. Now, this is why I'm saying that reading the, let's say, the economic survey and the other budgetary announcements is so important, because, I mean, to some extent, we might be doing crystal ball gazing, but at the same time, we get a sense of what is the policy level thinking and where it might be headed. So in that same paragraph, the recommendation was that, the need is for high personal income taxes, and I'll come to the next slide also when with respect to this aspect. Uh, with respect to agriculture, also there was a statement that a reorientation of these policies might unlock the immense benefits of the agriculture sector. And I think the last 2 points would be on how the life insurance premium has gone about. For example, they made a very important observation that if you see the COVID years, the life insurance premium skyrocketed because there was pandemic risk and there was more awareness. But then in the next year, we have seen a sharp decline in the policy premiums, in the policy premium growth, because there is a fading pandemic risk and the recent changes which were made with respect to high value policies. Now, why I said on the high personal income taxes, because these two are the charts which are there in the economic survey. Now, what they say that yes, there is number one increase in gross tax revenue to GDP ratio, and yes, number two, the tax revenues have registered a steady increase over the years. But I wanted to highlight the last paragraph that broadly about 55% of our tax revenue comes from direct taxes, 45% from indirect, and these are in line with government's effort to enhance progressivity in taxation. So as we have always seen the progressive taxation slab in income tax, this is the line on which the policy level thinking might be. And these are something which I'm reading from the economic survey. So that is why I thought I'll bring about these aspects, that it is important for us to sort of understand the hidden points which are there in these very important crucial policy level documents. Because at one place, the economic survey did observe or did take a note that yes, there is a recommendation to enhance the taxation of capital gains. Now, be that as it may, let us now move on to let's say, the meaty part of this session as to the tax rates and holding period with respect to the taxation of non-financial assets. Now, if you see this table, on the top table deals with the tax rates. And what I've done, I've divided that into the current rate and the proposed rate with effect from 23rd July. So as you see on the short-term capital gains, there is no change. For non-corporates, the slab rates will apply. For corporates, the applicable corporate income tax rate will apply. As we see for non-corporates, for individuals, etc., the surcharge rate can go up to 25%, 37%. When we talk about long-term capital gains, and this is where the change has happened. See, currently our long-term capital gains on the sale of non-financial assets, they are taxed at a rate of 20% with indexation. And when we talk about non-corporates, the surcharge rate is capped at 15%. So at max, the effective rate for a non-corporate taxpayer, an individual, etc., can go to 23.92%. The proposal is that with effect from 23rd July 2024, this rate gets reduced to 12.5%, which is a good point, and that is where this has been marked as green. But B, it is without indexation. Now, the surcharge rate if you take the maximum effective rate at the 12.5% base rate, it comes to 14.95, so practically 15%. The important thing is without indexation. Now, indexation as a concept has been there so as to ensure that a person does not pay taxes on the gains earned merely on account of inflation. If you are earning something just as a price adjustment, or let's say as an inflationary adjustment over a period of time, the government says that no, you're not required to pay tax. And this was the fabric for long-term capital gains taxation. But now at a 12.5% without indexation, because that, and the reason that they have stated is they want to simplify. There were many rates, there were different kinds of computation mechanisms, etc. But now no indexation is to be given. Now at a period of holding, if I see, till now there was land, building, unlisted shares, they were given a 24 months holding period to qualify as a long-term asset. Other assets used to continue at a 36 months, and the typical common let's say non-financial assets could be gold, silver, intangible assets. So for them to be qualified as long-term capital asset, that is to say for being eligible for a concessional rate of tax, the taxpayer was required to hold that asset for a period of 36 months. Now in the proposed regime, it has been reduced to 24 months. So any other asset, if you hold for 24 months, you are eligible for a long-term capital gains classification. Now, if you see these, there are three types of amendments. The rate is reduced, the indexation has been removed, the period has reduced. So all these points, something helps at least some taxpayer. The rate reduction helps someone. Indexation benefit, we'll of course see with the case studies how it goes about. But the period of holding reduction is something which is good. Now, what will be its interplay with a land and building, or the incentive for people to own immovable property, that also we'll see in the ensuing slides. Now, what are the key noteworthy points when we talk about these benefits? Yes, the indexation benefit has been taken. Yes, the tax rate has been reduced, but the indexation benefit continues at least for transfers undertaken before 23rd July. So, which will mean, let's say if there is any transfer, if Mr. A has sold his or her property to let's say Mr. B before 23rd July, yes, that benefit will be available. If a taxpayer has converted capital asset into stock in trade before 23rd July, yes, the indexation benefit will be available. If a person has contributed, let's say, capital asset into a partnership firm or an LLP before this date, yes, the indexation benefit will be available. But yes, that comes with an additional cost. The tax rate will also be the higher one. The period of holding, as I said, has been reduced from 36 months to 24 months. For land and building, there is no change as such, because for them, the period of holding till now also was 24 months. Now, what happens when we talk about the 1st April 2001 assets? Now, as we know, there is a provision in income tax law which specifies that if a property was acquired before 1st April 2001, then that is the base year, that is the base date which has been set. Let's say, in a form of a hybrid grandfathering, in that for those properties, the cost of acquisition will be at the option of assessee. Either the original cost of acquisition or the lower of the FMV of that asset on 1st April 2001, or the stamp duty value as on 1st April 2001. Now, logically, the assessee would like to take the higher of, let's say, either the original cost of acquisition or lower of these two figures. Now, after the budget, there had been this one confusion, this manner of computing capital gains, the cost of acquisition for assets acquired pre-2001 has been, let's say, now clarified by the government also. But I think what happened just after the budget was one confusion which arose as to what will happen to pre-2001 properties, that whether those properties will continue to get the indexation benefit. Now, does it mean that if I have acquired a property in the year 1999 and if I want to sell it today, then will I get the benefit of indexation even if I sell it after 23rd July? So there was one confusion in the manner of how things got reported. But as such, there is no provision there is no carve out for those assets. So Indexation now will not be available. Yes, the 2000, the base year, the 2001 date, that will be available. It's not that if I've acquired the property in 1999 for, let's say, 100 rupees, and even if the 1st April 2001 value was, let's say, 500 rupees, that I will be required to pay tax in accordance with 100 rupees. No, that benefit of 100 versus 500 will still be available. There is one question which has come up, or let's say, another issue that is now being in discussions is what will happen to interest and stamp duty cost, which has been acquired for, let's say, the acquisition of capital asset. Would that be part of the cost of asset for while computing the capital gains? So see, there are some rulings which are favorable rulings which are there, but recently, I think yesterday or before day before, some reports are coming, which are suggesting that no, they won't be allowed as part of cost. So now we'll have to see if any clarification comes or if there is any amendment in this proposal during its passage in the parliament. Now, as you would have heard, I'm harping on the point of this particular date because all these amendments are applicable for this from this particular date. Now, if we see the cost inflation index numbers, now again and again, this point has been going the rounds that what happens, what is so relevant about the cost inflation index? See, this is the relevance. Now, from 2001 to till today, the cost inflation index has increased from 100 to 363, which in essence means that the Government Income Tax Act believes that something which was available that at 100 in 2001 is now available at 363. So like 3.6 times. It takes approximately 11 to 12 years, around 12 years to double in the first part. In the second decade, it took, let's say, about 8 to 9 years to double. And now I think the next 100 points will be shorter. But the point is that what this means is that if you acquired something at 100 in 2001, and if you have sold that thing for 363, there would have been no capital gains tax trigger, which means that at least your gains are protected to 3.63 times if I'm talking about this financial year. But going forward, this benefit goes on. This benefit goes away. Now, how does it impact? Does it impact all the stakeholders? Does it impact only a particular section of stakeholders? Is something that now everyone is doing their maths and number crunching because this is a provision which is not affecting everyone equally. It is depending on facts and circumstances of each and every taxpayer. Now, what will be the date of transfer? Since this particular amendment has come from middle of the year, it is very important that the date of transfer aspect becomes relevant. Because see, till now, what used to happen if you transfer an asset, let's say, there are multiple, when we talk about transfer of an asset, and let's say immovable property, there are multiple events which are involved. There would be execution of sale deed, there would be payment of stamp duty, there would be registration of the property, consideration between the parties will be exchanged, there will be giving delivery of possession by one party to the other. But if all those things happen in 1 year, at least from income tax perspective, it was sort of irrelevant, at least when I'm talking about the capital gains computation, because Income Tax Act looks at one full financial year and not a particular date. But now this particular point has gained and regained importance as to what will be the date of transfer. And since this is an amendment which has got introduced in between, extra care and caution will need to be taken when people are filing their return for this FY 24-25 if they have any capital gains incidents in this year, and especially in these, let's say, the nearby months, June, July, August, if there are some things which are overlapping or spreading or spilling over pre-budget period and post-budget period. Now, I mean, there has been the precedent has been that if once the documents get registered, the transfer will take place on the execution date and not on the date of registration. Because see, registration law allows you a certain period of time within which you are allowed to go and get your documents registered. But if the parties have agreed that yes, we have transferred all risk, reward, title, etc. on a particular date, then that will be regarded as the relevant transaction date once the registration takes place. And we'll do this in one of the case studies also. Now, to understand the impact of this removal of indexation, the reduction in tax rate, let's see, there are 4 to 5 scenarios that I've sort of built in. And case study 1 and 2, I'm dealing with a situation that the assessee acquired the property post 2001. So there is no, let's say, 1st April, there is no relevance of 1st April 2001 value. Now, let's say in case study 1, the cost of acquisition for the person in June 2001 was 20 lakh rupees. And the value has multiplied 50 times. So now it is selling at 10 crore rupees. Now, what is happening is that if you see in the proposed regime column, the person is making a commercial gain of 9 crore 80 lakh rupees. Now, and that is because of 10 crores minus 20 lakh rupees. Now, the benefit of indexation used to be, if you see in the current regime, this 9 crore 80 lakhs gains used to be reduced by the indexation benefit. So your indexation used to eat up certain portion of your capital gains. So if you see in the current regime, the person will be required to pay tax on a capital gains of 9.27 crores, because the government believes that yes, to some extent, there is just an inflationary adjustment which is going on. But in the new regime, what will happen now, that person will be required to pay tax on 9.80 crores. At the first blush, someone will say that yes, this is going to be higher tax incidence in the proposed regime. But if you look at it carefully, the applicable tax amount in the proposed regime in this scenario, in case study 1, is much lower. And why does it happen so? Because in this case, even though there is no indexation, but because of the high appreciation that that person has enjoyed, there is enough headroom so that his tax rate goes down. The appreciation is much more than the benefit of indexation, and this is where this is why I was saying that yes, this is an impactful provision, but it doesn't affect every pocket equally. For a person who has earned great appreciation in a non-financial asset, for that person, despite the removal of indexation benefit, the reduction in capital gains tax rate is much more beneficial. Now take the flip side. Same cost of acquisition in case study 2, but the property is not appreciated 50 times. The property is appreciated, let's say, only 5 times, so at 1 crores. Now in this case, what would have happened? The person would have paid the person has let's say earned capital gains of 80 lakhs. Because of the indexed cost of acquisition benefit, the capital gains taxability would have reduced considerably, because this person in this person's case, the indexation benefit is too high. If you see the gain that he has earned is 80 lakhs, but because of indexation, that person is saving 72.6 lakhs of capital gains, 72.6 lakhs of the indexed cost of acquisition. Now in this particular case, the person is paying higher tax in the proposed regime, because in this person's case, the indexation benefit was much more than the benefit that this person is making due to the reduction in the capital gains tax rate. And these are all real practical situations that we are seeing post this budget announcement. We are seeing that there are people who were either earning, let's say, loss before this particular proposal, now they are in a gain position, and in flip side also, people who are earning gain before this position and now they're in a loss position. And loss, when I'm saying commercially. If we talk about the 1st April 2001 scenarios, if the person has, again, if you see in the first case study, and that is interesting because see, typically for the properties acquired before 1st April 2001, generally it is said that the cost is actual cost or stamp duty value, whichever is higher. But if you see, technically that is not the correct way how one has to read. If you see case study 1, the cost of acquisition in 1990 was 5 lakh rupees. The stamp duty value on 1st April 2001 was 10 lakh rupees, and the FMV was 12 lakh rupees. Now, what will happen in this case? The cost of acquisition will be, and the assessee has a choice to choose between A, 5 lakhs or the lower of 10 lakhs or 12 lakh rupees. So of course, it becomes 10 lakhs, and in the option that is given to the taxpayer will logically choose 10 lakh rupees as the cost of acquisition. Now, this is the important part that I wanted to highlight, because generally people, normally say that, okay, for pre-1st April 2001 properties, the cost is cost or stamp duty value, whichever is higher, but that is not the case. Now, if the property has appreciated 20 times, so 5 lakhs has become, let's say, 1 crore in terms of sale consideration. Again, if you see, there is a appreciation much more then the indexation benefit. Now the indexed, what happens because of the indexation, the 10 lakhs cost in the current regime just goes to 36.30 lakh rupees. So yes, the capital gains amount is much lower, but the applicable tax goes high because that person has to pay tax at a higher rate. But in the proposed regime, such a person will be required, the amount of tax this person will be required to pay will be less because the tax rate has gone down, and this person is not saving much because of the removal of indexation, is not saving much because of the indexation. Now these are just hypothetical examples. You can put, I mean, you can filter any, input any number into this. People can calculate what is the break even, etc. But the point is, uh, if there is a case of low appreciation, as you can see in case study 4, again, let's say 5 lakhs has become just 50 lakh rupees, then the benefit of indexation is much more, because in that case, what happens, the cost gets inflated to a figure which is much near to the sale consideration. So as a result, the quantum of capital gains which has on which tax has to be paid shrinks to a very small amount. And when that base shrinks to a very small amount, logically the applicable tax figure goes down. And that is what something you can see in the case study 4. If the property has appreciated not at a very high price, the appreciation is very low. So in that case, the assessee will end to, I mean, in a low appreciation scenario, the assessee benefits if the indexation option is available. In case of in the case study 5 that I want to discuss, this is what I was telling about on the date of transfer. Now, see, these are hypothetical dates that I'm taking. It may not be exactly matching, but the point is, let's say if the payment of stamp duty has happened before the budget day, if the date of execution, if the sale deed has been executed before the budget day, and if only the registration step is remaining to happen after the budget day, then there is a great argument to say that yes, the date of sale in this case is before the budget day itself, and therefore higher tax rate but with indexation. And when I say argument, because yes, there are multiple, I mean, these events will not happen just in silos. People will also have to see, okay, when the consideration transferred, when did the possession get delivered, etc. But these are, and this is an important determination that now people will have to do. As against this, if let's say stamp duty date was same, registration date was same, but the sale deed execution happened after the budget day, and that is the important thing, that on which day parties are agreeing that yes, I have transferred it to you, and you are agreeing that you have acquired this from me. If that date happens after this, then logically yes, it is I mean, this is a transfer which one will have to say happened after the budget day, and therefore get impacted by this change. So important thing is, for people who are transferring non-financial assets or even financial assets during this year, especially near the budget date, people should take extra care and caution when they're filing their ITR. Of course, if and when any cases get picked up for scrutiny, that might those would be sometime later in life, but adequate documentation, support, etc. should be maintained to support what is the relevant fact. If the transfer is before this date, then also adequate documentation, etc. should be maintained, and it should be well prepared in advance. And even if it is after this date, then appropriate documentation supporting, etc., that filing, everything, records should be kept maintained from day one itself. Because if at all any questions, scrutinies, etc. come in, it will be very hard to find out these small things, that okay, when was stamp duty paid, when was the registration date, when was the sale deed execution, if there are multiple parties involved in a sale, when will you say that it was registered, when will you say that the sale actually took place. Let's say if the seller has given a power of attorney to someone else to execute the sale deed, which date will you take? Will you take this power of attorney date? Will you take the sale deed date? If there is, let's say, a situation in a state where an agreement to sell happens before the sale deed, which date will you take? There might be even scenarios where, uh, let's say, when a builder gives a property, the execution date, signing date is different. So there are multiple factors when possession letter is given. Under construction properties, what will happen, which date will be taken. So therefore, this determination of date of transfer will become very important, and one must take into account and take extra care and caution, because it is possible that uh, internal errors etc might creep up, which can put the taxpayer in unnecessary trouble as to prove that what was the date of transfer and what should be the capital gains taxation rate which should be applicable. Now, in terms of impact, I think one thing is very clear, what will, and everyone is talking about what will happen to the real estate sector prices. But before I do that, I think we all want to know, okay, as when we were doing the case studies, I mentioned the word, what will be that cutoff growth rate? Everyone is, you know, trying to calculate that what would be the cutoff rate, the break-even rate, where I'm, let's say, equal, and no regime is affecting me in a different way. Now, these are three portions which I've culled out from some articles. And if you see what they say, that no matter the purchase date of your property, if the annual growth rate of the property's price is below 9%, there is a high probability that the new rule will push you towards the losing side. But if the property has grown annually by 10% or above, the new rule might end up giving you better benefits. And this is why I took those case studies of low appreciation and high appreciation. So if your property has appreciated at a good pace, then the removal of indexation benefit will not haunt you. But if the property has appreciated lower, then the removal of indexation benefit might haunt you. And now if we see what has been the percentage or growth rate in our country in the property prices, now this is the important part, that the who will be the affected class. I think mostly people who purchase property, let's say in the 5 to 10, this in the recent past 5 to 10 years bracket, because that article states that most of the cities except Hyderabad have seen an annual property price growth of below 9%. So for those people, the benefit of indexation was much more than the actual commercial appreciation in the price. Because if the price is not appreciated by a great pace, then the indexation benefit was taking your cost to a higher level, so that you were able to gain this benefit and the reduced tax cost. And if in terms of cities, I think other than MMR and Chennai, these are cities which have seen about less than 5% CAGR in terms of average housing price over the 5-10 years. Others have seen majorly 5 to 10%. So if we link the third bullet to the first bullet, it looks like that most people who have purchased lately in the last decade or so might be the tax cost could be a little bit higher, because the property has not appreciated as much as the indexation benefit was there. Now, question is, what will happen to the real estate sector? Now, does it mean that it has lost its sheen? Because till now, what used to happen in terms of other major investment classes other than the financial assets, real estate and unlisted shares was something else, but real estate used to get the benefit of a 24-month holding period. That is to say that you were required to hold it only for 24 months. The moment you held it for 24 months, the next day if you sell it, you are eligible for a long-term capital gains tax classification. Now that relative advantage is not there. Now, whether you buy a real estate or a gold or a silver or an intangible asset, everything gets qualified into long term at the expiry of 24 months. So that relative advantage is not there, at least. Does it mean that the sector has gone down? Arguably no, because this is not the primary reason by which a person would acquire real estate. There could be many other factors, but yes, this used to be a decent enough reason for a factor for people to take the decision. But yes, it is not the only reason. Now, how will it impact is something in the next, I think in the next year or so, we should be, or maybe in the next few months also, we should be able to understand, because from today on also, once this bill becomes an act, this particular thing has become effective. The second point is, and this is in some circles, this is getting highlighted as to what will happen on the valuation bit. Will it mean that there will be again the risk of undervaluation, of course, up to the circle rate? Will that be the case? Now, this is something which time will tell how people, let's say, look at it and how are they getting affected, etc. But this is a risk which is getting highlighted in certain circles. Then I think now all those sections 54, 54 EC, all those things will be will gain more and more advantage, because uh, those are the capital gains saving bonds, and if people, and of course up to a certain limit, will it mean increase in purchase of those capital gains saving bonds is also something which in the next few months, or maybe in the next 6 12 months, we'll get to see that difference. But yes, in terms of impact, these are few areas where one should keep a close watch and close eye, because I mean, this is linked to the growth rate of your property. From next year, it will again depend on how, at what time you acquired the property and what time you sold. But it is this impact, as I said, it is not affecting everyone equally. It is not affecting everyone in an equal fashion. Its impact is dependent on the growth that your particular property has earned between the acquisition date and the transfer date. If the growth is much more, honestly, the person is not concerned with the indexation benefit. If the growth is not up to the mark, or let's say a little bit less, then the indexation benefit was very much helpful. There is one more point which I think is relevant on this aspect. It's not just linked to capital gains, but the TDS on the property purchase, the 1% TDS they're used. So which is applicable if you purchase a property in excess, the consideration exceeds 50 lakh rupees. So there used to be this one doubt that, let's say, if Mr. A and Mr. B jointly purchase a property for 90 lakh rupees from Mr. C, then whether the TDS trigger will apply, because Mr. A is paying 45 lakhs, Mr. B is paying 45 lakhs. Will this TDS trigger apply, because the threshold is 50 lakh rupees? So now that has been clarified that yes, it will be linked to the consideration value. Secondly, what happens if A purchases a property for 90 lakhs from B and C? Again, 45 lakhs to be paid to both the parties. So that has also been now clarified that it is linked to the the consideration for the property. The number of buyers or number of sellers will not be relevant to decide whether this TDS trigger kicks in or not. So now I think all in all, to summarize, I think the point is that for when we talk about non-financial assets, A, uh, the long-term capital gains tax has been rate has been reduced from 20% to 12.5%. The indexation benefit has been taken away. The period of holding has been reduced from 36 to 24. How will it impact? As we saw in the case studies, it is not the same for everyone. People will have to do their benchmark, people will have to do the number crunching exercise. But at a general level, as I said in the previous slide, uh, if the growth rate is not much, and if you have acquired the property, let's in the recent past, then the growth rate might not be that much. So therefore, in that case, the particular indexation benefit would have been helpful. How it can be implemented in a different way is also that, the FMV as on 22nd July, or maybe the indexed cost as on 22nd July, they can be grandfathered. And this is we have an instance, we have a similar example to the 31st Jan 2018 grandfathering in case of listed shares. So we should be watchful of as to whether during the passage in parliament, whether this particular proposal gets amended, and at least the indexation benefit which had got accrued till date, that gets, let's say, protected. But we'll have to see as to how this proposal comes in, because if it is at least protected till date, people will say that yes, then it's the government's policy prerogative whether they want to discontinue the indexation benefit. But at least till date, the indexation benefit that had accrued, at least if that can be protected, or the appreciation in value can be protected, or in some fashion an option can be given to the taxpayer. So those are the things which we should be watchful as to whether this proposal undergoes any change during its passage in the parliament. So I think the one last point which I think, if let me just see if there's, yes, I think I can cover this 5 minutes on the slump sale point. See, there is the period of holding has been reduced, as I said, from 36 to 24 months, but that amendment has come in section 2 clause 42A. Now, slump sale, that particular computation mechanism and the whole code comes from section 50B. Now, in the period of, now what happens in a slump sale? A person transfers a business undertaking as such to another person for a lump sum consideration. Now, and it is regarded as a capital asset, so the resultant gains are capital gains. Now, whether it will be long-term capital gains or short-term, it depends on the period for which that whole undertaking was held. So the holding period of individual assets are not relevant. is not relevant. If the undertaking has been held for more than 36 months, it is regarded as a long-term capital gains. Now, what has happened is that the period of holding for slump sale doesn't come from section 242A. It is specifically mentioned in section 50B itself. So now there is one confusion as such, or I mean that one issue which has been undergoing the discussions is what will happen to the slump sale transactions. If we see the bill and the law, there is no mention of slump sale, but what is happening is that the government has clarified that now the holding period has been simplified and there will be only two holding periods, uh, 12 months and 24 months. So if we go by that logic, it might be possible that the slump sale holding period gets reduced, or we'll have to see whether this has been intentionally not touched on, because maybe the government feels that this is a different class of asset. So the only reason why this sort of confusion or this discussion etc started with respect to slump sale is because the clarification that has come that now the holding period will be only two types, 1 year and 2 years, whereas this 36 months in case of slump sale comes specifically from section 50B, which has not been touched upon or which has not been talked about. The computation mechanism for capital gains in case of slump sale remains the same. That is to say that you take the FMV of assets transferred, you compute it in a particular prescribed manner, and you reduce the net worth of that undertaking, and then what you get is the resultant capital gains. For net worth also, there is that same formula that you aggregate the total assets of that division and reduce the liabilities which are appearing in the books of accounts. The resultant figure is the net worth. Net worth is essentially the cost of that undertaking. Uh, for slump sale, the successor tax liability risk exposure remains same. There is no change on that, which I mean, by that I mean that the tax authorities can recover the seller's unpaid tax liabilities for the year of transfer up to the date of transfer and one prior year. So from the purchaser if it cannot be recovered from the seller. So we should also be watchful as to whether any amendment takes place with respect to slump sale holding period or not, because that is a period which comes separately from the section itself, and it is not linked to 242A, at least as of now. So that is also something which we should be mindful of. So this was it from my side, Ridhima.
Thank you so much for a wonderful session, Raghav. I think there were some real concerns when these changes were introduced, especially for removable property. And I think you addressed them pretty effectively. Before we conclude, I would like to take few questions on behalf of our audience and also some of my personal questions.
Sure.
So the rationale was behind to simplify capital gain, correct? What do you think could have been a better approach in that computation of the capital gains for people in general, or everything was addressed by the finance minister?
So as I said on the suggestions bit, I think one way in which it can be done or could have been done is if we protect at least the FMV as on budget date,
Right.
or if we let's say protect the indexed cost as on that date, and we have a precedent for that in the act itself, the grandfathering benefit of 31st Jan 2018. If that could have, I mean, that is a manner I think which can be adopted, and I think during its passage in parliament it's possible that this proposal might undergo a change. Yes, it will need to have its checks and balances, because then you can't have that a person who opts for indexation, that person should not get the benefit of a lower rate of taxation. I mean, the government will also say that. So I think a fair balance can be adopted. I mean, an option can be given to the taxpayer that
Yeah, I
if you
think
want,
option is better.
option is better, I think. So that is
Hmm.
something one should be mindful and watchful of.
And you are hopeful that something like this would come before it gets the president assents?
I mean, I mean, it depends on how much stakeholder consultation, how many people represent that this is a genuine concern, and
True.
how much revenue foregone in that mathematics the government does. But I think this is a point which is, I think, doable, at least because there is a precedent also in the act itself for this.
Okay. And there is one more thing, something related to JDA, one of our audiences asked, is how do you the changes in the holding period and tax rate affects the joint development agreement? Because specifically, what are the tax implications if the JDA is entered into before July 23rd, but possession is of the land is handed over after the date?
So I think I'll take that question into two parts. One is
Okay.
the JDA. In case of JDA, the date of transfer has already been subject matter of a litigation. I mean, there has been
Correct.
different views, etc. A few years back, there was at least one amendment which was brought in Section 45 with respect to, I think, individuals and HUFs. I mean, individuals, that if they, what will be the relevant date on which the transfer takes place. So I think because of the amendment, there won't be change in that determination. You will continue to calculate and determine your date of transfer applying those existing principles. But important is, if at all that those events, let's say possession, let's say allowing the other part, the builder, to come and step into the property and do the work, uh, the stamp duty, etc. If at all those days happen nearby these, let's say before something happens before and something happens after, that is something which will be critical to take care, because the impact, as I said, is can be in huge numbers depending, of course, on the cost and sale consideration, but the impact can be huge. So that thing will need to be taken care of appropriately.
Okay, right, absolutely. And I just said that there can be and can be not situation for an impact on the real estate markets. So can we see that altogether shooting of the prices of the property can be a bit monitored with this? No.
I mean, see, there are always both sides. As I said, one is real estate might have lost its relative advantage, at least in terms of period of holding. But
Hmm.
is that a very major concern for for an investor? Maybe not, because there are other, the person in, when a person is investing, of course, this is an investment advice, so maybe the real estate investment advisors might be best placed. But I think when a person is doing that, so they are looking for more and more of commercial appreciation, but this benefit at least has gone away. So from that perspective, see, there are two ways to look at it. One is that the tax rate has reduced by 7.5%.
True.
Now, indexation is something which today we know that is something at least now part of proposed history. After 2 years, 3 years, this will be the law. So when a person will buy now, they will always factor in at least this part of the cost. As I said, the valuation related concerns which are being cropped up as to whether this will lead to again, let's say valuation concerns in real estate transactions. That is something which in the next 2-3 months, or maybe in the 2 months also, government will monitor and then take a call, because this, its impact will be uh, immediate for real estate deals.
Got it. Got it. All cool. Thank you. Thank you so much, Raghav. Thank you for your time.
Thank you, Ridhima. Thank you, Taxman.